All right. Today is Sunday, the 22nd of May. This is a recap for the stock market activities last week and an outlook for the week to come. And folks, yes, I got a good one for you tonight, although the topic of the macro discussion we're about to have is not that good. Despite that, we try to do our best here in presenting the information, so let's do that, and here it is. In focus tonight, Unavoidable, the looming hunger crisis and how stagflation will make it much worse. We start with this. The headline reads, a food insecurity expert predicts that there is only 10 weeks of wheat supplies left in the world as Russian invasion disrupts production. So we got only 10 weeks left before we run out of wheat completely. And that makes me think, how the hell does the Olive Garden still has unlimited breadstick promotion going on? And perhaps the key to solving this hunger crisis is to invade the Olive Garden and steal their resources, because they obviously have unlimited resources. But all joking aside, this is becoming a major problem. I mean, can you imagine what Italy is going to look like without bread and pasta? I can. Back in 2008, when the wheat shortage was not even as close as it is right now. We've seen bread strikes and riots, and this is about to happen all over the world, not just in Italy. So how did we get here? We have to put it in perspective, because the media would tell you it's all about the Russia-Ukraine crisis. It's all about the war that's going on in Europe right now. That is part of it. But here's a chart of wheat, a weekly chart. Even before the invasion happened, wheat went higher by almost 75.5% since the bottom in 2020. So what was the key in producing this inflation? The answer is inflation has always been a monetary phenomenon, meaning when the central bank of the world, the Federal Reserve of the United States of America, starts printing money like crazy to prop up the stock and real estate markets, to protect the assets of the wealthy who freaked out and panicked during the Great Panic of 2020 due to the thing that we cannot even talk about right now. The Fed ushered the tsunami of liquidity, inducing inflation, and since the commodities market is dollarized, everything is traded in dollars. It doesn't matter whether the Mozambique or the Chilean central bank printed more money or not, because when the Fed of the United States prints an insane amount of money, producing that inflation, the prices of commodities worldwide move higher. So the Chilean consumer, the African consumer, the Indian consumer, the Chinese consumer, everybody pays the market price of these commodities. So the key to inflation has always been the monetary policy. Now, you sprinkle a little war and supply chain problems due to the lockdowns of the thing, and now you got the perfect formula for the biggest inflation storm in history. And the key to this inflation, when we talk about food inflation and the upcoming hunger, perhaps famine crisis, is 3 commodities. Number 1, wheat. Number 2, cooking oil, specifically sunflower oil. Number 3, fertilizers. We can add number 4 as corn, but it's not that important right now because China is about to produce more corn. So we're going to stick to the 3. Wheat, sunflower oil, and fertilizers. When we talk about wheat, which countries are the top producers of wheat in the globe? The answer is, at number 1 by far, Russia. 20% of the global wheat production comes out of Russia. Well, we have sanctions against Russia, so we cannot import wheat from Russia. That is 20% poof, gone from the global supply. Now we got Ukraine with about 8% of the global wheat supply. Well, there is a war going on, and the ports are all shut down, so there goes another 8%. So we got at least 30% of the wheat supply, poof, gone. And that leaves countries like Canada, for example, US, India, and China. These are the top producers of wheat. And as you can see, the major increase in wheat production coming from Russia, India, and China. Well, we know China has its own food security goals. They're not going to export wheat to the rest of the planet because they view this as an essential part of their food security. Now you might ask, what about the US? We talked about that in details in another video, and I explained to you exactly why US farmers are planting more soybeans and they're letting go of corn and wheat crops. And the reason is there are no fertilizers. And with the shortage of fertilizers, farmers have to plant crops that are less demanding of fertilizers. We know wheat and corn are very demanding of more and more fertilizers. Soybeans, on the other hand, they're less demanding. So there goes the US to substitute the loss of wheat supplies from Russia and Ukraine. What about India, you might ask? Well, if you haven't heard, India has been under a massive, insane heat wave, which could reduce the wheat supply by 10 to 50%. Unbelievable. It's like every headwind, every disaster is hitting at the same time. Everything is colliding here. And of course, the genius head of the Federal Reserve in this country, Jerome Powell, would argue that this is not his fault. He's just unlucky. The war started all of a sudden. We have a heat wave in India. We have the avian flu. All of these factors are producing more inflation. It's not the Fed's fault. The Fed created this inflation. Maybe these are boosters to the inflation, but the Fed is the primary creator of this inflation. And they could have paused and stopped this before it happened. But anyways, what about Canada? Can Canada substitute the loss of wheat supplies from Russia and Ukraine? Absolutely not. Farmers in Canada are struggling to plant crops in fields that are either too wet or too dry, testing the world's already tight grain market. So there goes Canada. Any hope that the Ukrainian wheat supply is going to get out? Well, Ukraine has wheat that was planted last season, and this wheat is ready to go. The problem is, the majority of Ukrainian wheat comes from the south and the eastern regions. Well, guess who's occupying these regions right now? The answer is Russia. And of course, the Russians are controlling the south, the east, and they're expanding. And they're not letting Ukrainian wheat supply to get out, whatever left of that supply to begin with, because Ukrainian farmers either leaving the country altogether or not planning for understandable reasons. There is a war in the country. But the Russians are saying, hey, you want the Ukrainian wheat to get out? Well, let our wheat to get out too. Remove the sanctions. Well, we know the West is not going to remove the sanctions anytime soon, so we're not going to get wheat out of Russia or Ukraine. Now, here are the countries that are most dependent on Ukrainian wheat exports. Number one, Egypt, by far. And by the way, last time around, we've seen food inflation at this magnitude. It was back in 2011, 2012. And guess what happened in Egypt and the Middle East? The Arab Spring, which resulted in removing regimes that were in power for decades. Massive political destabilization. We have a country like Indonesia, also dependent on Ukrainian wheat supply, Bangladesh, Pakistan, Turkey, Morocco, Tunisia, Yemen. You're noticing the theme here. Mostly poorer countries and mostly Middle Eastern countries. We've seen what happened before. The Arab Spring. Could it happen again? Yes, it will. And it could be much uglier than before. And it's not just going to happen in the Arab world, by the way. Look at what's going on in Sri Lanka right now. Look at what's going on in South America and Peru. Things are going to start to heat up significantly. And of course, the Russians are using food diplomacy. If you're allied with the West, you get nothing. If you're allied with Russia, you get something. And we're seeing the Russians, for example, donating wheat supplies to Cuba, a country that is already under sanctions to begin with. But the importance of this war when it comes to the global supply, specifically of grains, is not limited to wheat. When we look at the Ukrainian bread basket, this is what it's called because it feeds Europe, at least. We talked about Ukraine producing 8% of the global wheat supply, but they also produce 12% of barley supplies, 13% of corn supplies, and a stunning 47% of sunflower oil supplies, the largest producer of sunflower oil by far. Why is sunflower oil important to begin with? Here it is. We use sunflower oil in the production of cookies, chips, and many other food items, specifically packaged food items. If the prices of sunflower oil continue to climb, these food items will become even more expensive to the end consumer, producing more and more hunger. Now, U.S. farmers are catching up here by planting more sunflowers, but that's going to take a year at least before the oil hits the market. In the meantime, the only substitute available is, unfortunately, palm oil. And palm oil is disastrous for the environment. For example, the majority of palm oil comes from Indonesia. And by the way, those palms, they're not native of Indonesia. They're native of Nigeria and Africa. But because Indonesia is geographically closer to China and India, the largest consumers of cooking oils, it is convenient to plant palms over there and feed India and China. Here's the problem. To do so, there's a lot of deforestation involved. We're talking about massive amount of the forest gone, completely burned. And you can look at the map of the island of Sumatra, for example, or Java, and you can see miles and miles, as far as the eye can see, of these palm oil plantations. All of these plantations replaced forest. Well, number one, this is destructive to the environment. You're cutting away forest. Number two, precious wildlife is being pushed to the brink of extinction. We're talking about animals that survived thousands of years, moving from Africa, from northern Asia to India, all the way down to Indonesia, such as the Sumatran tiger, for example, the rhino, the elephant, and of course, the orangutan. All of these animals are going to go extinct if we continue to expand the reliance on palm oil. And of course, you have these out-of-touch billionaires, the oligarchs, likes of Elon Musk, for example, who says we cannot let humankind end in adult diapers and that the environment would be fine if we doubled our population. This is supposedly the smartest man on the planet. But in fact, the man is a lunatic. This is the same guy whose brightest idea, by the way, is to move us to Mars. Have you checked what the average temperature on Mars is? Minus 81. Yeah, that's the brightest man on the planet right now. Hey, Elon, how about using your billions to fund producing edible cooking oil in a lab, for example? That'll save this planet. We don't need to move to Mars to begin with. But anyways, here it is. Indonesia produces 35% of the global edible oil supply. Russia produces 5%. Ukraine produces 6%. And here's the problem. We can take the Russian and Ukrainian supply of oil entirely off the market, or we're going to be fine. But the problem is, any substitute of sunflower oil is going to cost you an arm and a leg, be it soybean oil, be it canola oil, or the most available, palm oil. The prices of palm oil have been exploding higher, and this is the cheapest edible cooking oil, by the way. The problem is, even the country that produces the most palm oil in the globe, Indonesia, is suffering from domestic shortages. And just a few weeks ago, they initiated a export ban of palm oil, and that sent the prices of soybean oil, for example, soaring. Without cooking oil, we get a massive problem here. Now, the good news is Indonesia lifted some of the ban as of late, but that doesn't solve the problem at all. We have a massive shortage of cooking oils, and the prices are moving significantly higher. The demand is not waning down at all. The supply is nowhere to be found, and hence we have a massive shortage of cooking oil. And the third item we have to talk about when we talk about the global famine that's about to come. We talked about wheat, we talked about cooking oil. Let's talk about fertilizers. The majority of fertilizers, unfortunately, come out of Russia. Well, we have sanctions, we have a war, we cannot import fertilizers out of Russia. Now, even if you live in a country like Canada, for example, the top producer of potash, you're also facing, Canadian farmers are facing massive increase in the cost of fertilizers. How do you explain that? Well, because let's say Indian farmers depend on Russian fertilizers, Brazilian farmers depend on Russian fertilizers. If they cannot get their hands on that supply, then they're going to have to compete on whatever left, in this case, Canadian supply. And therefore, that pushes the prices higher. And even though Canadian farmers have an abundant supply of potash in the country of Canada, they have to pay an arm and a leg for it because, again, everything trades in a global market, a global commodities market that is pretty much dollarized. But again, as you can see, the number 2 producer is Russia. Number 3 is Belarus. These two countries combined produce about 17 million metric tons of potash, way more than Canada. Both of these countries are under sanctions. They cannot export this supply of fertilizers, even if they wanted to. So now we're taking away a massive portion of the supply of potash in the globe. Canada cannot substitute that at all. They have to more than double their production to substitute the loss of supplies from Russia and Belarus. And that is not even remotely possible at all. Another important breadbasket on the planet besides Ukraine is Brazil. Brazil is a commodities giant. They feed a huge portion of the world. But guess what? Brazilian farmers depend on Russian fertilizers to plant their crops. 22% of the fertilizer supply in Brazil comes out of Russia, 6% comes out of Belarus, and then the rest comes out of China, Morocco, Canada, and other countries. A lot of them are under conflict or destabilizations. As a result, imports of fertilizers in Brazil are very hard to get. And now Brazilian farmers are taking a shot and saying, hey, let's plant wheat in the heat and see what happens. Maybe it's going to happen. This is an act of desperation, by the way, because what is more important than bread? Brazilian farmers are now desperate for fertilizer. They're seeking supplies from countries like Morocco and Jordan, but even these countries have limited supplies. They cannot fully substitute the loss of supply from Russia and Ukraine. And the sad part of all of this is the fertilizer supply is here. It's in Russia, but it's not getting out due to the sanctions. So we have to ask the question, are the sanctions really worth it or not? Because the war is not stopping. It's not going to stop anytime soon. On the other hand, we're creating a massive global famine. Look at these prices, by the way. North America fertilizer price to the moon. The New Orleans DAP spot to the moon. New Orleans urea to the moon, with no stop in sight here. So it doesn't matter what the farmers are going to plant. They're going to pay more for it because they have to pay more for fertilizers. You might have heard the earnings report from a company called Deere, and Deere is saying we cannot pass the extra cost of inflation to the end user, the end consumer, in this case farmers, because farmers are being squeezed. They have to pay more for fertilizers, so they're not upgrading their equipment as frequent and as soon as Deere would hope to. We've seen the stock of Deere getting crushed on Friday. And this massive global food shortage is pushing governments to become more and more nationalistic, more and more defensive by keeping whatever supplies they have to the domestic supply. So if you're a country that produces more fertilizers than you need, you're going to store that instead of exporting it because you're going to need it at some point domestically. If you got more wheat than you need for now, you got to store that because at some point you're going to need it here in your country. So you're not going to export that. So this protectionism that's going on in the world will exacerbate food shortages. And as a result, we're getting tragic readings and forecasts. For example, last year alone, people facing acute food insecurity surged by 25%. That is last year alone. Wait till you hear the reading for this year and the year after that. This is a major problem. We're talking about hundreds of millions of people on this planet will go hungry. What do you think that will result in? Riots, uprisings, political chaos, and then some. The UN is now warning that Russia-driven food shortages mean cereal and corn will start running out in 2023. The UN adds the world faces the risk of food shortages. It's not just sunflower oil. It's not just wheat. It's not just fertilizers. It's also corn. It's oats and many other grains. This is a massive problem to the point where the UN chief is now warning that the war in Ukraine is threatening a spiral into a global hunger crisis. Senile leader Janet Yellen, the Secretary of Treasury in this country, says the Ukraine war fallout threatens stagflation and hunger. Yellen warns that 10 million more people face poverty due to higher food prices. And here's the New York Times sounding the alarm. Poor countries face a mounting catastrophe fueled by inflation and debt. Folks, this is way bigger than 2008-2009 because the magnitude of the crisis is global. The level of debt that we have right now is way bigger than 2008-2009. We're having inflation the likes that we've never seen back in 2008-2009. We're having a war. We're having a flu. We're having a virus. We're having lockdowns. And on top of that, central banks across the globe, unlike 2008-2009, they don't have ammo to re-stimulate economies. I hate to say it, but we could be looking at the biggest and most intense global crisis in almost 100 years. Certainly the biggest famine in the 21st century. The UN warns that 20 million people risk starvation in the Horn of Africa as the drought conditions worsen. These people in the Horn of Africa and countries like Somalia, for example, they still have to pay the same price of wheat that you and I are paying for. And they cannot afford that at all. On top of that, you got another civil war going on in Ethiopia. Things are getting dire, folks. And in countries like Afghanistan, remember Afghanistan, which we were supposed to bring freedom and happiness and joy and prosperity to? Well, here it is in Afghanistan. People are selling babies and young girls to survive. And the IMF came out with a dire warning that governments must protect the vulnerable when things fall apart. Even the IMF admitting that things will fall apart. Even in this country, the richest country in the world, we're seeing hunger, we're seeing food, unaffordability crisis going on. Look at all of these projections, by the way, in the U.S. Department of Agriculture. For all food, the expectations were last year that food inflation will be up by 2 to 3%. Now they say 5 to 6%. In certain items, such as dairy, for example, the projection last year was that dairy inflation would be at around flat to 1%. Now the projection goes 8 to 9%, and it keeps going on for all food items. Be it fruits, vegetables, sugar, pork, beef, veal, everything is moving higher, exceeding all expectations from last year. And again, in this country, the richest country in the world, we're seeing a shortage in baby formula. We're seeing American babies going hungry and being sent to the hospital due to the shortage in baby formula. Take a look.
Now to the baby formula shortage that it seems to be growing more dire by the hour. Tonight, more hospitals are reporting children needing treatment because they aren't getting enough nutrition due to the crisis. Here's CBS's Jamie Yukas in Los Angeles.
Parents are becoming even more frantic as formula becomes nearly impossible to find. A lack of formula has sent at least 4 babies to a children's hospital in South Carolina. An Atlanta hospital is also treating children due to the shortage.
Would you describe this as a crisis?
Oh, absolutely. I have never seen anything like this.
And what is the solution, by the way, from the gaslighting green cult that caused this problem to begin with? They say inflation is making everyone spend more, but it could be the driver to saving our money and the planet. What does that mean? You guessed it. I don't need to read it for you. But they say this is an opportunity to reduce our consumption of meats, and that would save the planet by producing less carbon. This is an opportunity for all of us to reflect and become vegans. Inflation is good. Look at it this way. We can save the planet if we all become vegans. Another one that says why vegetarians are winning the inflation battle. So it's not the fact that the central banks induced this inflation to protect the assets of the wealthy by propping up stocks and real estate. No, that's not the problem. Holding our Fed officials and our politicians accountable, that's not the problem. It's your fault. You've been eating too much meat. That's on you. You've been driving more than you really need to, pushing gas prices higher. That's all on you. And this inflation is an opportunity. If you don't like higher gas prices, poor you. Get yourself an EV. You don't like higher meat prices? Poor you. Become a vegan. Even Bank of America says eat more fruit and call mom to ease the price pain. This is in South Africa, by the way. This is what Bank of America says. You cannot afford food? Poor you. Call your mom. Eat more fruit. Matter of fact, let them eat cake. Here's another one from the Washington Post. It's actually written by Bloomberg, but anyways, says the inconvenient truth that could prevent global famine. And spoiler alert, here it is. Each person who replaces beef with plants saves almost a quarter acre, which could free these acreages to fully offset such shortages as one caused by the Ukraine invasion requires 250 million to 250 million North American and Europeans adopting the beef to plant transition, which will reduce current North American and European beef consumption by 42 to 45% and 14 to 18% respectively. So again, if you're poor, you're middle class, and you're suffering from inflation, you cannot feed your family, poor you. That's on you. Become a vegan. If you don't like it, who cares? We got no empathy for you at all. Courtesy of the satanic green cult that lobbied against oil and gas, against nuclear energy, in Europe that lobbied against expanding ranches and expanding the cattle supply, all for the hopes of renewable energies and saving the planet. How is that going right now? How are you saving the planet right now? Because as far as I'm concerned, we have to do more deforestation in Indonesia right now to plant more palms to feed the planet. How is saving the planet going on by the green cult when they haven't even produced the so-called green energy? You don't like high gas prices? Poor you. Get yourself an EV. An EV that would cost me 60, 70, 80 grand because the prices of lithium are surging out of whack? Where is the lithium to begin with? You see, they started this aggressive transition abruptly without having the substitute. So they shut down our supplies with no substitute available. And you wonder why we're here right now? Here it is. Inflation is hurting women at the grocery store. Apparently, we have women in this country sleeping hungry. Where are the feminists, by the way? The hotshot celebrities? Are they talking about this? Of course not. And now the World Bank says global energy prices will soar 50% this year. And this is the largest commodity shock since the 1970s. Now, why is stagflation the worst possible scenario right now? Because in stagflation, prices continue to stay higher. Matter of fact, they continue to move higher. But we see a slowdown in the pace of economic activity, meaning economic growth slows down, which produces more and more unemployment. The result of that is you get more hungry people, but no food to feed them because the prices of food are going to continue to go higher, continue to stay higher, and the supplies are nowhere to be found. And here is economist Mohammed Al-Arian, who says that stagflation is unavoidable. We are, by the way, in stagflation right now. Take a look.
You've been banging the drum about the Fed being too late. Is a recession at this point now unavoidable in the U.S.?
It is not unavoidable, but unfortunately the probability is going up. What is unavoidable is stagflation. And we're seeing growth coming down, and we're seeing inflation remaining high. And the Fed is finally catching up to developments on the ground, but it still has some way to go.
Okay, so if you look at stagflation, what does that mean for stocks? How much of it is already priced in, or how much more volatility will we get?
And here's the presenter right away. What about the stock market? Who cares about the stock market? What is the impact of stagflation on the economy? What is the impact of stagflation on the upcoming famine? But all they care about is the stock market. and this is the core of the problem to begin with, this obsession with the stock market from central banks across the globe. And by the way, this situation was avoidable. Here's Mohammed Al-Arian once again.
Stagflation is the worst thing for central banks, especially for the Fed, because it puts its two objectives in conflict with each other. And that's why a lot of us wanted to avoid this situation. And this situation was avoidable. That's what sort of upsets a lot of us. It was avoidable had the Fed not stuck to its transitory inflation characterization. Now that we're here, it is very hard to find a first best policy outcome. So the Fed is going to have to make a very difficult choice. A lot of people say it needs luck and skill. Well, it needs a lot of luck at this point.
But of course, you central bankers, these criminals, all of them, with no exceptions at all. Take, for example, St. Louis Fed president, who's already touting the upcoming easing by the Federal Reserve. All of this is happening because they're freaking out the stock market is going down. And they want to talk the market into, hey, it's not really that bad. We're going to cut interest rates again sooner or later. So please stop selling your stocks. This is all what they care about. Because if the stock market goes down, the monopoly of power the deep state globalist oligarchy has in this country and many others fades away. So they got to keep that stock market propped up. But despite their best efforts, things are falling apart anyways. And even former economist Stephen Roach is now sounding the stagflation alarm. And he says the markets are not even close to discounting the full extent. So if you think the hit that we got so far is enough, you haven't seen anything yet. And certain Fed zombies are actually waking up to that fact. For example, here's Kansas City George, Esther George, who said that the policy is not aimed at equities market. Oh really? Are you joking now? Your entire policy was aimed at rescuing the stock market in 2020 during the Great Panic. Now you're saying it's not aimed at the equities market, but she assures you, oh, it's going to be felt there. Meaning now that the oligarchs sold as much stock as they can last year at the top, of course it hurts them when stocks go down, but they're not going to feel as bad because they have plenty of cash right now and they can buy all of these stocks at pennies of the dollar when the crash happens. But who's going to get crushed in the stock market? The answer is the mom and pops, you and I, the retirees. Those are the people who are going to get crushed in the stock market. But of course the Fed doesn't care. Of course the deep state globalist oligarchy doesn't care because they've already cashed out for now. And if the stock market must crash, then it should crash on the heads of the peasants, not us, the 1%. The oligarchs. This is how they view it. And even Goldman Sachs CEO says there is a 30% chance of a recession within the next 12 to 24 months. Let me fix this one for you. Here it is. Yep, there is a 100% chance of a recession within the next 12 to 24 months. Goldman Sachs CEO will say eventually. After the recession happens, of course. Anyhow, folks, with this lovely macro discussion, very positive, right? We have to move on and cover the stock market for you. And we start with the performance of indices last week. And here we go. On Friday, the Dow Industrial Average closed pretty much flat after being down big midday, yet it managed to close in the green by 8.77 points or a gain of 0.03%. The Nasdaq, similar story here, a recovery day, even though the Nasdaq closed down by 33.88 points or a decline of 0.30%, but it was down much more than that midday. The S&P 500 averting a bear market reading by closing in the green and gaining 0.57 points or a gain of 0.01%. We're going to talk about the theories and what happened when we talk about the charts analysis because it is quite peculiar. You have the S&P 500 hitting the bear market territory down 20% from the top, and then by the end of the day we see the recovery and closing back in the green like nothing happened. But here it is, the sector's performances on Friday. Number 1 capturing the gold medal, healthcare. Number 2 for the silver, energy. Number 3 for the bronze, REITs. And the laggards of the day led by cyclicals, industrials, and communication services. Let's contrast this with the weekly performance of the sectors. At number 1, capturing the gold medal, materials. Number 2 for the silver, energy. Number 3 for the bronze, healthcare. On the other hand, the laggards of the day led by defensives, cyclicals, and technology. The advance to decline ratios on Friday, NYSE 45% advancing versus 51% declining. The Nasdaq 42% advancing versus 53% declining. And again, under the hood, when we look at the 52-week highs versus the 52-week lows, the picture is clear. We have a lot of weakness and the bias remains to the downside. Moving on to commodities, both the WTI and Brent eked modest gains, less than 1% on Friday. Gasoline was flat, heating oil was down around 1.5%, and then natural gas down almost 3% on Friday. Now, the news that we have over the weekend is Russia is shutting down gas to Finland from Saturday, so this should impact natural gas prices in Europe, but it should also impact natural gas prices here in the US because who is going to substitute Finland's lost supplies of gas from Russia? Maybe Norway can do something here and there, but it's going to be mostly LNG from the US. And again, the question is, how long will it take for the U.S. to substitute Russian supplies of gas? That's going to take years. Maybe we can cover some of the supplies lost in Finland, in Spain, but that's about it. Because you look at the deal that Germany made with Qatar, for example, that's going to happen in 2024. So what happens between now and then? Either the Germans have to continue to pay for Russian natural gas, and they're doing so, by the way, in rubles, so they're bowing down completely despite the tough talk. And the main question is, what will happen if Putin decides to cut natural gas supplies altogether amidst the winter season of the European continent? We have to start thinking about that right now, not wait for it to happen and then respond. Anyways, here's softs. Lumber continues to slide down, losing almost 3% on Friday. Yet we have more losses here, led by cotton, down over 3% on Friday. Likewise, cocoa was down almost 2%, coffee down almost 1%. Yet we got gains from OJ, almost 2.5% gains for the day, along with sugar, closing the day with gains of almost 1%. Metals, flattish, and the reason is the US dollar was up modestly, so we're seeing gold flat, silver flat, losing a little over half a percentage point, but flattish for the most part, considering the magnitude of the action we've been getting so far. Platinum is down almost half a percentage point. Copper is up, on the other hand, almost half a percentage point. And then we have palladium, the loser, on Friday, down almost 2%. And then we got meats, modest downside for both live and feeder cattle futures. But here comes the new big tech, lean hogs, scoring gains of over 3.25% on Friday. And why do we say it's the new big tech? By the way, here it is. The year-to-date gains, the NASDAQ is down almost 30%. On the other hand, the new big tech lean hogs gained over 33.5% so far this year. Anyhow, back to the futures. Let's talk about grains. Fortunately, wheat is down 2.5% on Friday. So was oats, down also almost 2.5%. Likewise, we have corn down a little over half a percentage point. Yet we have gains across the board, led by canola. Canola gaining almost 2% on Friday. Soybean oil, the oils are moving higher. Soybeans, soybean meal, rough rice rebounding higher by almost 1.5% on Friday. Moving on to the big casino, the options market. What's going on here? The volume is moving higher slightly. Is this a good sign? Yes, it is, but we have to see more. Remember, the four conditions that I gave you. Number one, short covering. We're seeing some of that. We're seeing a lot of that actually on Friday. And last week, we've seen that on Monday too. Then number two, the U.S. 10-year yield has to cool down. We're seeing that. Number three, the dollar index has to cool down. We're seeing some of that. But number four, the participation of retail and institutions alike in buying call options. We haven't seen condition number four yet. Are we starting to see that? Perhaps. Because here it is, Apple at number one on Friday at around 1.8 million contracts traded for the name, or about 52% of those were calls. At number two, Tesla, the souffle, at around 1 million contracts traded for the name, around 47% of those were calls. We need to see more calls for Tesla to move higher and rebound from after losing 700 of support. And then we have AMD at number three, at around 750,000 contracts, about 60% of those were calls. Here are the unusual activities that took place on Friday in the casino. Number one, the ticker KSS for calls, another retailer that got whacked last week, but somebody's betting for a rebound here. They're buying the 47.5 calls for the expiration date, June 17th, with expectations that calls could rebound higher by more than 21% by then. They paid around $2.20 a piece to enter this trade, all in all spending around $3.3 million. What about the ticker EWZ for the Brazilian ETF? We're seeing the rebound in commodities, and if commodities go higher, so will the EWZ. In this case, they're buying the $40 calls for the expiration date, June 3rd, with the expectations that the EWZ can move higher by more than 19% by then. They paid around $1.50 a piece to enter this trade, all in all spending around $2.7 million. And then we have the ticker TSLA, Tesla. We have two of them. Let's start with the calls. they're buying the 700 calls for the expiration date, May 27th, with the expectations that Tesla could move higher by more than 5.5% by then. Mind you, this is with the expiration date of next Friday. They paid around $16 a piece to enter this trade, all in all spending around $17.5 million. And then we have the put option trade at the bottom of the table for Tesla again. In this case, they're buying the 630 puts for the expiration date, May 27th, once again next Friday, with expectations that Tesla could go down by 5%. In this case, they paid around $18 a piece to enter this trade, all in all spending around $7 million. And what about the trade for the ticker GM? Warren Buffett added GM, so did Mama Cathy Wood, but the stock is not responding higher at all. Perhaps this week it will. Somebody's saying that by buying the 42 calls for the expiration date, July 15th, with expectations that GM could move higher by more than 18.5% by then. They paid around 60 cents a piece to enter this trade, all in all spending around $600,000. And lastly, what about the ticker COIN? Coinbase? A lot of pain in the tulip market, but we're seeing some signs that a rebound is coming not just in cryptos, but across the equities market, and this will help Coinbase higher. So they're betting by buying the $80 calls with the expiration date of June 17th that Coinbase could rebound higher by more than 21% by then. They paid around, let's say, $4 a piece to enter this trade, all in all spending around $4 million. Moving on to the heat map analysis. Here's the heat map on Friday. Again, a mixed picture across the board. You have some winners, some losers. The majority of the winners came from Big Pharma. We're going to talk about Big Pharma in a minute, but we're seeing losses, notably Tesla. We're going to talk about Tesla in details in the charts analysis, but we also saw declines in Nvidia, AMD, the major chips names. The retail apocalypse continues. Names like AutoZone down big. Names like Dollar General. The pain continues in retail. We also saw pain in Deere and Caterpillar, and I explained that in details in the macro portion of this video. And as a result, we're seeing fertilizer stocks moving down, be it Nutrien, be it Mosaic, all getting hit on the heels of the results from Deere. Now, let's contrast this with the weekly heat map, and here it is. More pain in the northern side of the map, the cyclical side, the technology side, and now, oh, by the way, the defensive side. And notice the pain in the big caps. Now they're shooting at Apple, at Google, at Tesla, at Amazon, and they're starting to shoot at the industrials. The names that have been beating inflation so far, such as the defense contractors and now Deere, UPS, FedEx, and the railroads, UNP, Union Pacific down big, over 7% this week alone. Meanwhile, what's working? What's working is some of the metals on the heels of the optimism that China might lift, keyword might, lift the draconian lockdown in Shanghai, and therefore we saw aluminum higher, Alcoa, we saw Freeport-McMoRan, for copper moving higher. But again, the majority of the gains came from healthcare, specifically the big pharma names Pfizer, Eli Lilly, Merck. And here's the take, folks. I tweeted this on Friday. The reason why big pharma stocks are holding fine is the fact that they can pass the extra cost of inflation easily. We're seeing even Walmart struggling to pass the inflation cost, but not the big pharma names. Why? Because after all, the end consumer is the Medicare fraud that abuses taxpayer money every single day. Whatever price big pharma is charging, the government pays, with no watchdogs, with nothing at all. Therefore, you're seeing these hospitals and doctors with massive mansions of Ferraris and Lambos. Why? Because they're scamming the government. They're scamming the taxpayer. They can prescribe whatever drugs they want for you. They can charge whatever they want for you. And both big pharma and the healthcare providers can suck on the tit of the taxpayer via Medicare and squeeze out billions of dollars. If Pfizer wants to increase prices, who cares? The taxpayer is going to pay via Medicare. So we're seeing resiliency in the big pharma names. Then let's talk about the defense contractors, specifically Lockheed Martin. We know that Sweden and Finland are applying to join NATO. Yet we have one small problem here, which is Turkey. Turkey is blocking the application by Sweden and Finland to join NATO. And of course, this is just a little trick by Erdogan to secure whatever concessions and whatever weapons he can get his hands on. We know that Erdogan is pissed off because he did not get the F-16 jets from Lockheed Martin after he bought the Russian defense missile system. And of course, the Biden administration is working something out with the Erdogan administration in Turkey to secure those F-16 jets. Yet we have another problem. Greece is now demanding that they join the F-35 program if neighboring Turkey is about to get the F-16s. So we have a battle here. We have multi-tailwinds for Lockheed Martin. Number one, you got Sweden and Finland joining NATO, which means both countries have to up their defense spending. Where do you think that spending will go to? The answer is the pockets of Lockheed, Raytheon, General Dynamics, etc. Oh, and on top of that, now we have Turkey. It appears that they're gonna get the F-16s jets. So that's another score in the pocket of Lockheed Martin. And on top of that, we have Greece, who wants F-35s now. So there you go. You have triple tailwinds for Lockheed Martin. So the key here is, in your investing portfolio, you want to stick with these criminal organizations, the big pharma, the big military-industrial complex, because what inflation? Just keep robbing the taxpayer for more cash. Who cares? And then we have GM. GM says that they sold out of the Cadillac Lyric, I believe, the EV. Here's the problem. My hunch is Cadillac will not be able to fulfill all of these orders due to the supply chain restraints. So be careful here. This might sound good on face value, but the key is, can GM deliver on all of these orders? Perhaps not. And then we have Meta, also known as Facebook. Meta says, we're defending our gamble on the metaverse because it's going to be worth $3 trillion someday. Here's the correction for you. The metaverse will be worth 0. And since we're talking about Facebook, let's talk about Twitter. The Twitter versus Elon Musk saga continues. And the last rumors were Elon Musk, now that Tesla stock is down, is about to pull out of the Twitter deal. And he's going to use the bots as an excuse to pull out from the deal. Well, now Twitter says the deal is still here. Elon is going to pay $44 billion. Nothing to see here. Please disperse. Please go back to your desks. Everything is fine. But here's Ralph Nader. Remember Ralph Nader? Used to be anti-war. Now he's applauding sending $40 billion to Ukraine to fund the proxy war. Anyways, he says, prediction, Elon Musk will withdraw his bid from Twitter within a week or so. Key reason, Tesla stock used as collateral for his gigantic bank loans to take over Twitter is collapsing by the day. He's already lost about $80 billion in equity. Watch for the reason he gives. And I agree with Ralph here. If Tesla stock continues to go down, Elon Musk is going to weasel his way around and say, oh, my goal was just to expose Twitter. I wasn't really serious about buying the company for $44 billion. It has more bots than previously disclosed, yada, yada, yada. And if that happens, folks, it's going to be a major, major problem with the SEC. And Elon Musk is going down, so is his souffle stock, Tesla. And lastly, in corporate news, here is Delta Airlines, along with United. They say U.S. airlines like Delta and United Airlines are so desperate for pilots, they're dropping some requirements and considering cutting training hours to get more pilots flying sooner. What could go wrong here? Hey, you like flying planes? Do you have any experience before? Oh, you don't? No problem. Come over here. We'll get you flying those planes within a week or so. What could go wrong, right? Specifically if you're flying one of those flying coffins from Boeing. Anyways, moving on to the heat map for the ETFs. This is the weekly heat map, and the picture is clear for the week. Both value and growth are down, but value is outperforming growth. Look at the IWD, for example, versus the IWF. And then we have international markets doing pretty good, specifically the EWZ. Now the commodities are rebounding, be it gold, be it silver, be it uranium, be it oil, be it gas. Commodities are moving higher again. You're seeing the reflection in the ETFs, the OWH, the XOP, the XLE, the GDX, UNG, all blasting higher. And now we have the EWZ as the outperformer once again in international markets for the week. The majority of the pain came from the XRT, the retail names, cyclicals, the XLY, consumer staples, the XLP. Now that we're getting signs that these supposedly inflation-proof companies are struggling to pass the inflation cost. Number one. Number two, the demand from the consumer is waning down. This is at least the assumption for now, and therefore you're seeing massive pain in the XRT, XLP, and the XLY. We have more earnings, which we will talk about in a minute now, after the charts analysis. These earnings will either negate the pessimism and negativity that came out of Walmart and Target, or they will reaffirm the fact that retail is struggling to pass the inflation cost. And oh, by the way, the consumer is weakening anyways. And here it is, charts. Let's start with the 30 minutes chart for the SPY, the S&P 500. Now the chart broke the important support, 385.15, but it closed above that, and this is an important fact to keep in mind. The chart did not close below 385.15, so we're not placing massive trades, buying put options when the chart did not close below 385.15. The support remains 385.15, the resistance now 392.39. The fact that the chart pierced below this number is ominous in nature, but we're not going to place this big options trade buying puts until the chart closes below 385. Now, tomorrow's activities will be critical. Why? For that, let's talk about the daily chart for the continuous contract for the SPY. And as you can see for now, at least at the time of the recording of this video, the futures are up. Let's say the SPY opens gapping up higher in the morning. The assumption is the sellers will show up right away. We will see a flush down. The key is, will we see dip buying and a rebound after the initial selling or not? If we see dip buying and a rebound after the initial selling is done, that is ultra bullish, indicating a big rebound rally is coming. If, however, we see the sell-off from the morning continues and we see key support being lost, then you know for sure this is ultra bearish and you should start thinking about buying put options for real this time around. But the action we're getting so far last week made me into a day trader because I cannot place long-term puts or calls with conviction. So I became a day trader and I only opened 3 trades on Friday. One for the Qs, one for Tesla, and one for Apple. Now I'm going to discuss those in details. But for now, is the chart trading above or below 3,855? Let's say, to be conservative, 3,850. The answer is it is trading above. So can you short with conviction? Of course not. Can you buy the chart, buying the dip, betting on a rebound with conviction? Of course not. Why? Because if we get a rebound, we're going to stop at 4,102 at best. Then we're going to meet stiff resistance. If that level is broken to the upside, then that's going to unlock a massive rebound higher. That could get us all the way to 4,300, if not more. So it is up to you. If the chart breaks above 3,960 and closes above that number for the day, then you can play buying call options all the way to 4,102. That's up to you. But the ultimate confirmation will be when the chart closes above 4,102. When we look at the volume, it is moving higher. Lots of volatility on Friday, options expiration, etc. But the momentum indicators are bottoming, in my opinion at least. The momentum indicators are saying all conditions are ready for a rebound rally from this point on. The question is, where are the buyers? Where are the folks who are buying call options to ignite this rally? Because the environment is ready for a rebound rally, but we got to see the buyers showing up. Here's the SPX daily chart. The bears will continue to hang on the fact that the SPX closed below 4,000. The bulls would argue, wait a minute here. Number one, the candle closed pretty much at the highs of the day, off the lows of the day. This is good, not bad. And oh, by the way, when we remove all of these markings, what if this is an ABC formation? Or we're done with the C leg, meaning we go higher from this point on. This is at least according to the bulls. The bulls also have the momentum indicator, be the outside, the MACD on their side. The bears would argue, it doesn't matter that the SPY closed at the highs of the day on Friday, reversing the early losses. I wouldn't make much of that because it was options expiration, lots of short covering, last minute decisions, etc., etc. And that led to the rally in the last hour of the day. We'll see who's right, and therefore tomorrow is decisive in the battle between the bulls and the bears. Here's the Qs 30 minutes chart, similar story. It pierced below 285, but it closed above it by the end of the day. So do we have a confirmation that we should go all in shorting the Qs? Not yet. Yes, it pierced below it. We're talking about 285, and that gave us a day trading opportunity. But we're not going to place a massive put options trade until the chart closes below 285. Therefore, for now, 285 remains support and the resistance at 291.21. And again, if we open higher tomorrow, gapping higher, the assumption is we will see the sellers showing up right away, perhaps closing the gap. The question from that point on becomes, are we going to see a rebound and buying of the dip? If that is the case, ultra bullish. If not, and we see 285 broken as support once again, ultra bearish. And here's the day trade that I made in the Qs on Friday. This is from my Robinhood app. So you know that these are risky, wild shot, day trading kind of activities. I'm not using my Schwab or E-Trade account. I would do that for serious trades. And you should do the same, by the way, because if you bid big using Robinhood, and then you get stuck for whatever reason, Robinhood is down. What do you do now? But if you're just using Robinhood for speculative activities, in options trading, you're fine. Just make sure it's not your major trading account. But here it is. When I saw 285 being broken as support for the Qs, I bought some of the 280 puts and I held on to them for a little while. I bought them for $4.49 a piece and I closed them about 30 minutes later for $5.50 a piece almost. In, out, hello, goodbye. always be closing. And here it is, the daily chart for the continuous contract for the Qs. Again, did the chart close below 11,689? The answer is no. We're still keeping that as support. That's good for the bulls. Another point, the momentum indicators appear to be bottoming for now. The waiting for a spark. Just a little bit of dip buying, a little bit of call options buying, and we will see a big rebound rally. Am I going to go all in buying call options in the Qs? No, not until we see the highs of the reversal candle being taken out. Am I going to go all in buying puts in the Qs? Of course not, until I see a decisive closing below 11,689. For now, that remains support. The resistance we have is 12,207. What about the IWM? A 30 minutes perspective, it did a lot better than the SPY and the Qs because it did not pierce below the previous lows. So that's good. It went down all the way, the previous gap, closing that gap at around 172.80, and then it rebounded higher above 174.22. Is this bullish in nature or not? I would argue it is. It is showing strength, but I would have liked to see a little more, such as recapturing 177.14, better yet 181 as support, but who's to say that the IWM is not going to do that in tomorrow's session? The assumption is for now, looking at the futures, is we will see a gap higher. Then comes the sellers. How far would the sellers get us? Let's say closing the gap in the morning. Will we see a rebound? If there is a rebound, if there is dip buying, you're going to go along the IWM at least for the day. But if we see the selling continuing, and we see 174.22 lost to support, be careful. If we see 172.80 and then the lows being taken out at around 170 and the closing happened below the lows, then you got the shorting signal. Here's the dollar index. It is moving down, but it has yet to lose decisively 103 as support. Once that happens, we will see a big pop in commodities, but specifically gold. For now, we're seeing negative divergences on the RSI, the MACD indicator, so it appears that we're heading that way. Here's the chart of gold. It reclimbed the trend line once again. It reclimbed the Fibonacci support around 1,845. We're seeing improvement in the RSI and the MACD, indicating that if you bared the pain all the way from 2,000 plus, all the way down here, watch the dollar. If the dollar loses 103 for real, then you might want to consider buying the dip in the gold miners, which I will do exactly. Here's the UK oil, Brent. Again, we have a rebound of 105.84, but are we above 114, 115? Of course not. We have to wait for that to happen. For now, we're not doing anything with this chart. Here is the daily chart for the 10-year yield. Again, we're seeing the head and shoulder playing out. We're seeing the bear flag playing out, but we're not going to feel secure until this one goes down to, let's say, 2.5. If it does, technically speaking, this will be good for the NASDAQ. The problem is it going to go down for the good or the bad reasons? Honestly, the market is not going to give a shit unless we see 2.5% being taken out of support. If that happens, then the market is going to say, whoa, wait a minute here. Did the 10-year yield lose 2.5% of support because inflation expectations are going down or because of growth expectations are going down? If it is the latter, it's going to be bad for the entirety of the stock market. But for now, here's a daily chart for the TLT. We're seeing the bull flag playing out, and we're eyeing 125.12 as the next resistance. We have some soft resistance before that, but this is the major one. The VIX 4 hours chart. Now pay attention now. This is the most important chart that guided me in my day trades on Friday. We got another resistance at around 33. The VIX got there and then it pulled back. The MACD for now showing green, meaning still positive momentum. You don't want to bet against the VIX by buying calls on the SPY until we see the MACD crossing and producing red impressions on the histogram. That would be the confirmation. And this is what I tweeted on Friday at around 10:30 Pacific time. The VIX will hit the 33 resistance soon. If that doesn't trigger buying, I don't know what will. And guess what? The VIX hit 32.90 and it pulled back, and equities caught a bounce right away. So the correlation between the SPY, the Qs, Apple, and the VIX was extremely important to watch on Friday, and it guided me to an incredible trade in Apple that produced over 1,000% gains in about an hour. We'll talk about that in a second, but here's the VXN, the VIX for the NASDAQ. It got resistance at around 39.99, let's call that 40, and unlike the regular VIX, we're seeing negative divergences in both the RSI and the MACD, showing that the VXN is weaker than the VIX, showing that the NASDAQ is stronger than the SPY, at least for now. If we see the trend line broken in the VXN, that would be a confirmation that the Qs should go higher. Here's Apple, a daily chart, and the good news for Apple is it did rebound, closing well above the lows of the day. The problem is it did not make it above 138.79 by the end of the day. Are we going to make a big deal out of it? Of course not. But if this number is broken again, that would be a confirmation that Apple is going down. In the meantime, Apple has negative divergences in both the RSI, the MACD, so it remains weaker than other technology charts. But here's the day trade that I conducted in Apple on Friday that produced over 1,000% gains. On top, the UVXY, a proxy for the VIX. At the bottom, the 5 minutes chart of Apple. Both of these charts are 5 minutes, by the way, for the same time period. Look at the correlation. The UVXY broke the trend line, produced a lower high, and then it flushed down from that point on. Apple, on the other hand, broke the resistance line, the sloping line of resistance, and it produced a higher low. And from that point on, Apple started moving higher. The VIX, in this case, the UVXY, moved down. So once I saw the algorithmic correlation, and folks, when they give you these trades on a silver platter, you gotta take them. I bought at around 11:25 Pacific time some Apple calls with the expiration date of the same day, May 20th. I paid around 23 cents a piece for them. An hour later, a little over an hour later, just before the close, these same call options were worth $2.50 a piece. So let's say that I bought them at 25 cents a piece and I closed them at $2.50 a piece. That is 1,000% gain in about an hour. Again, I'm not a day trader, but once they hand you these kind of trades, you gotta take them. And here's Tesla, the souffle and hourly chart. The most important support of 700 got broken. And unlike the rest of the charts, like the Qs and the SPY, Tesla did not reclaim 700 by the end of the day. Matter of fact, it closed below 700 for the day. Once the crossing happened, I knew that the algos are going to react negatively for Tesla, so I bought some puts, and that would be batch number 1. Batch number 2 is going to happen once we see 700 getting broken again as support. That is assuming Tesla is going to recover 700 as support at some point this week. If it doesn't, if it continues to slide down without getting at 700, then that would be a confirmation that batch number 2 should be placed. We double down on the put options. Now, depending on your expiration date, if you have a shorter expiration date, again, you always want to be closing. Always be closing. Because let's say you bought the 600 puts right after the crossing below 700 with the expiration date of this upcoming Friday. Now you scored big. You gotta book the profits. You got 1 week till expiration and you're way out of the money still. Now if you open the September puts with the 700 strike, for example, now you got more time to construct the trade regardless of how this chart is going to trade in the next few days and the next few weeks. Perspective matters. But the problem with the souffle is the long knives, the pitchforks are coming for Elon Musk. Now they're saying that perhaps Tesla should announce a $15 billion stock buyback. Not gonna happen, baby. This is desperate. Tesla cannot buy $15 billion worth of shares at these insane valuations. Even Elon Musk would not do it. But here comes the long knives, the pitchforks for Elon. Take a look at this article, for example, from Forbes. It reads, Elon Musk bites the hand that fed him by bashing California and Democrats. Now, I agree, Elon Musk is a freeloader. Without the generosity of California, Tesla was not even possible. We gave him that Toyota Fremont factory on pennies on the dollar. Now, when California said, hey, you got to pay a little more taxes and perhaps take care of your factory workers, that's when Elon bailed out and went to Texas. So yes, legitimate criticism, but why now? Here's another one by the New York Times. Even among corporate raiders, Elon Musk is a pirate. Here's another one, the most important one, perhaps impacting the stock on Friday, and perhaps the most predictable one. Elon Musk has been accused of sexual misconduct. Anyways, moving on to tulips. Bitcoin, what's going on here? Still holding at 30,000, forming that bear flag, but asking, any buyers, any buyers, any buyers? We're running out of time, folks. If the buyers don't show up, the flush down will happen and the next destination will be 20,000. If the buyers show up, then we have 35,750 to look at. Until then, we're moving on to the conclusion of this video. What do we have on the economic calendar this week? We have a lot. Nothing on Monday, but Tuesday, May 24th, we have the manufacturing and services PMIs, the flash PMI. We also have new home sales. Wednesday, the 25th, we have durable goods, and we also have the most important FOMC minutes. Thursday, the 26th, we have initial jobless claims, and then we have GDP data and pending home sales. Friday, the 27th, we have core PCE inflation. This will be critically important. And then we have disposable income, consumer spending, and the final readings of the University of Michigan Consumer Sentiment Index. And after Friday, this will be a long holiday because we have, what is it now? Memorial Day? On Monday, the stock market will be closed. So again, you have to consider that if the stock market trades higher from Monday to Thursday, the assumption is on Friday, nobody wants to take a lot of risk heading into the weekend, so we'll see a sell-off. The opposite is true. If we see the stock market down all the way to Thursday, by Friday, the assumption is we should see some short covering ahead of the long holiday week. Now, on the earnings calendar, on Monday, we have Advanced Auto Parts. This is important because I attempted to buy this stock via calls, and I immediately got served a massive pie in the face after Walmart and Target crashed because all of the retails went down, including this name. The question is, will the earnings negate and put into question the action that we got last week, that perhaps these auto parts stores are doing fine and they should not be punished as, say, Walmart, Target, Dollar General, etc.? We'll see. Then we have Zoom, and on Tuesday we have another retailer, Best Buy, again, got severely punished after Walmart and Target. Is it justifiable or not? AutoZone, similar story with Advanced Auto Parts, and then we have Toll Brothers. This is an important indicator for the housing market. And then on Wednesday, we have Williams-Sonoma. Now, we got a lot of indicators that the poor, the middle class, the consumer is weakening in these demographics, evident by the crash in Ross, the crash in Walmart and Target. But what about the affluent consumer? Are they also feeling the pain? Are they cutting down on spending? We're going to know that by Williams-Sonoma's earnings. Then we have another retailer, Dick's, and we also have NVIDIA. On Thursday, we have Macy's and the most important name, Costco. And then we have Dollar Tree. Then on Friday, we have Canopy Growth. Again, a small, what do we say here? I can't say the W word. I can't even say the C word because otherwise the YouTube robot police will go, what's he talking about? So let's say it is a relaxation company. The question here is the consumer also cutting spending on relaxation? That would be an important indicator. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.